So today, we're going to tackle something that sounds super complicated, but is absolutely fundamental to modern finance: IFRS 9. This is basically the global rulebook that dictates how companies account for trillions of dollars in financial instruments. And don't worry, it all boils down to a few key ideas that we're about to break down together. I mean, just think about it for a second. When you look at a company's balance sheet and it's packed with everything from basic loans to really complex derivatives, how on earth do they put a number on all of that? How do we, as investors or observers, get a real true picture of what that company's actually worth? Well, for a huge chunk of the world, the answer is this one standard: IFRS 9. You can think of it as the shared language that companies all agree to speak when they talk about their financial health. So let's get fluent, shall we? We're going to walk through its core principles right from the very beginning of an instrument's life. Okay, so where do we even begin? Well, the first step is something called recognition. This is all about timing. It answers that simple but absolutely crucial question: when does a financial instrument officially get put on the books? You see, the core rule is actually pretty straightforward. It's not about what you plan to do or what you promise to do. In the world of IFRS 9, intentions don't matter. What matters is the contract. The second a company becomes legally bound by the terms of a deal, that's the moment of recognition. And this is where timing is just absolutely everything. So let's say a customer places a firm order. Does that go on the books? Nope, not yet. But the moment you ship those goods, creating what's called a trade receivable, boom, it's officially on the books. Or what about something like a forward contract? You recognize it on the day you commit to the deal, not weeks or months later when it actually settles. That distinction is key.
All right, so once something is officially on the books, we get to what is, let's be honest, the trickiest part of IFRS 9, and that's measurement. This is all about answering the question, okay, what's this thing actually worth, and how are we going to track its value over time?
But here's the cool part. IFRS 9 tries to make this super complex thing, well, simpler, by boiling it down to a two-question test. First, you have to ask yourself, why are we holding this asset? What's our business model here? Is it to collect payments or is it to sell it? And second, you look at the asset itself and ask, what kind of cash is it going to generate? Is it just simple principal and interest payments?
And depending on how you answer those two questions, you'll land in one of three buckets. If your business model is simply to hold an asset and collect basic payments, think principal and interest, it gets measured at amortized cost. If you're planning to both hold it to collect cash and possibly sell it, it falls into a category called fair value through other comprehensive income, or FVOCI for short. For pretty much everything else, like an asset you're actively trading, it gets dropped into the default category, fair value through profit or loss, or FVTPL.
Okay, that's a lot of theory. Let's make it real with a case study. We've got Design Co., and they loaned $9 million to one of their subsidiaries. Now look at the terms. No interest, no set repayment date, but it is repayable whenever they ask for it. So how do we classify this?
Let's put on our accountant hats and run the test. First, the business model. Is Design Co. in the business of trading loans to its own subsidiaries? Of course not. Their objective is simply to collect the cash when they need it. So that's a pass on the first test. Now, what about the cash flows? Even without formal interest, because it's repayable on demand, the cash flows are basically just the return of the principal. It's simple enough to pass the test. So the verdict is in. It's measured at amortized cost.
Okay, so after all that complexity for assets, you'll be happy to hear that the liabilities side is, well, it's way simpler. For the vast majority of financial liabilities, think company loans, bonds they've issued. They're just measured at amortized cost. There are a few exceptions, sure, but that's the main rule. Now, let's move on to what is maybe the single biggest change that IFRS 9 brought to the table. We're talking about impairment. This was a total game changer because it shifted the entire mindset from let's wait for a loss to happen to let's look into the future and account for the losses we expect to happen. Think of it like a two-stage warning system. When everything's going well and the credit risk on an asset is low, you only need to account for the losses you expect over the next 12 months. But if that credit risk suddenly gets a lot worse, you have to flip a switch and start accounting for all expected losses over the asset's entire life. And the whole thing pivots on this one key phrase: a significant increase in credit risk. This is the trigger. And we're not just talking about a payment being a few days late. This is a judgment call that there's been a real fundamental change in the odds of that borrower defaulting at some point down the road.
This Sparrow Co. example is perfect for seeing how this plays out in the real world. So picture this. In January, Sparrow Co. buys $10 million worth of bonds. Credit risk is low, everything's fine. Then, halfway through the year, there are reports that the company that issued the bonds is in serious financial trouble. By December, the market has reacted, the bond price has tanked, and that confirms it. The trigger has officially been pulled.
So because that risk level jumped so dramatically, Sparrow Co. can't just look at the next year anymore. They have to look at the entire lifetime of the bond and figure out the total loss they're expecting. And that number? It's a huge one. $4.5 million.
And bam, that $4.5 million hits the books right away as an impairment charge. It flows through the income statement, and on the balance sheet, it slashes the value of that asset all the way from $10 million down to just $5.5 million. This is IFRS 9 in action, forcing a company to show a much more realistic, forward-looking view of its financial situation.
Okay, so we've seen how things get on the books and how they're valued. But what happens at the end of the line? You know, when a loan is paid off, an asset is sold, or a company's whole strategy changes. Well, the rules for this part are pretty cut and dry. Derecognition, that's just a fancy word for taking it off the books when the contract is over. Simple enough. Reclassification is pretty rare. It only happens to assets, and only when there's a major change in the company's entire business model for managing them. And here's the one thing you absolutely have to remember, kind of the golden rule here. Financial liabilities, you never, ever reclassify them. Period. Okay, so we've been through a whirlwind of rules, tests, and categories. Let's just zoom out for a second and ask the big question. Why does any of this actually matter? What's the point of all this? Really, if you take one thing away from all this, it's that IFRS 9 is all about being forward-looking. It forces companies to be more honest about potential problems and to be honest sooner. That whole expected credit loss model, for example, is designed to stop companies from just waiting around for a disaster to happen before they acknowledge it. The goal is to give all of us a more timely and, frankly, a more realistic view of the risks a company is truly facing. And to wrap up, I'm going to leave you with a little paradox, a real head-scratcher that shows just how weird and counterintuitive the world of accounting can be. Think about this. If a company gets into trouble and its own credit rating falls, that makes its debt riskier and therefore less valuable. So, could that company actually report a gain on its own debt? The answer under IFRS 9 might just surprise you. It's a fascinating and pretty controversial yes. Definitely something to chew on.